Let's talk about how monthly savings versus monthly cash flow is completely different when you're talking about refinancing your home loan. So, doing a 30-year versus a 23-year mortgage, we're going to break down the difference and show you how that 23-year can actually help you pay off your home loan faster. Now, to be very clear, when I say a 23-year loan, I mean anything just lower than your normal 30-year. Not every lender can do this. Some only work in, like, say, 30 years, 25 years, 20 years, like intervals of 5 years. Many lenders like us, we can do some random period. So in this case, 23 years is going to be our example. But if you want to do a 27-year, 21-year, whatever it is, we can make those numbers work. Again, many lenders cannot, but we can. And I want to show you why it is so imperative that looking at that option, at least exploring that option, can help you decide how to pay off your home loan faster. Because again, monthly savings versus your monthly cash flow are very, very different. So the first thing we need to do when considering this is, what is the primary objective? Is it to, when you refinance, is the primary objective to save money or to just essentially reduce your term or reduce your monthly payment? So saving money is going to mean reducing the term of the loan, how long it is, right? So if you got an original 30-year mortgage, and in this example, we're going to say you went, let's say 4 years in. You're 4 years in on having this mortgage. Now you're looking at refinancing because rates have dropped. Do you want to save money or do you want to save cash flow? Right? Those are two different things. So monthly savings versus monthly cash flow. Let's talk about it. So in other words, monthly savings, right? The amount that actually you actually save over time, right? And so you build equity faster. If you have a shorter loan term, so in this case, let's say that 23 years, now you're paying off the same dollar amount, whatever your balance is going to be. You're paying that off in 23 years versus 30 years. So why is that important? It means more of your payment each month is going towards principal, less towards interest. So over time, paying that mortgage, you are actually going to have greater interest savings and build up the equity faster. Now, the trade-off is anytime you shorten that term, you're ultimately going to have a higher mortgage payment. So that impacts your cash flow, right? So monthly cash flow, meaning how much money you actually have to write the check for each month, will determine how much money you actually keep in your bank account, right? So the longer period, so in this case, the 30-year, right, it does mean a lower monthly payment obligation, which is nice because more money stays in your bank account. So which one is more important? That's going to be based on just truthfully you. What do you need and want, right? So the correct way to even make sure a refinance is worth it, we absolutely have an opinion. It's not an opinion, it's facts. There's a right way to do it. Most mortgage companies do it wrong. We'll make sure to put a link in here because that's a whole nother video on how to do it. But the short answer is compare actual savings, not what you write a check for each month. That's cash flow. Compare the actual savings. So now, to pay off your home loan faster, when we compare the 30-year versus the 23-year mortgage, we're going to break down that difference. A big piece of why it matters could be, not for everybody, but it could be mortgage insurance. So for those that don't know, mortgage insurance exists for conventional loans. It exists when somebody does not put down 20%. And so when you get to that 20% equity position, you get to cancel that mortgage insurance for those conventional loans. So why is that important? If you do a 23-year mortgage, you're building up your equity faster and more quickly you'll reach that date to where you can say, okay, the mortgage insurance can drop off. So by your home appreciating, you paying down a balance, the 23-year mortgage can absolutely help you get that done. Again, not just paying off your mortgage faster, but getting rid of mortgage insurance faster. That is huge. So now let's do a quick case study. We're going to look at monthly savings versus monthly cash flow, doing that 30-year versus 23 years. So we're going to call it Joe homeowner. Joe's got a current mortgage, and I am going to start reading here because I got to click over to find this. So I just took a generic $400,000 mortgage. So I took a $400,000 mortgage that Joe homeowner got, and we'll say Joe got a rate of 6.75. And 4 years in, it's to the point where Joe's like, man, rates have dropped. We're going to call it just random 6%. And we're going to say Joe's scratching his head saying, should I refinance or not? Well, the answer is, if Joe looks to take that, we're 3 or 4 years in, and he looks to reset the clock, so to speak, meaning we're going to go back 30 years to a new 30-year mortgage, Joe is going to save money. He'll save, call it $300 round numbers, right? And it depends. I mean, it doesn't depend. Like, you can do the math and figure that out, but I'm trying to use general just concepts here. So if Joe can save $300 a month, you're like, man, that's awesome. Good for Joe. So cash flow, $300 a month hitting his bank account. Again, it's not exactly 300, but to be very clear, just want to make sure that we're doing this for easy math. That means Joe will save about $3,600 a year in cash flow. He gets to keep an extra 3,600 bucks in his bank account. We're not bringing in mortgage insurance. We're not bringing in all the other stuff. We're just making this simple concept here. Now, the difference could be Joe now decides, well, heck, maybe I go ahead and I got to scroll to find this. Maybe I do that other mortgage, the 23-year mortgage. And why would he do that? Because doing a 23-year mortgage now, if he's 3 years in, we're going to shave off 4 years of his mortgage. So rather than adding three, right? Because we're going to reset a 27-year to 30-year. Now we're going to go the other direction, go to 23 years, and we're shaving off 4 years in doing that. And the reason why that math, and I'm using it for our example of 23 years, is it makes that monthly payment comparable to what he's paying today. Meaning after this refinance, Joe's not going to, quote, feel anything. He's going to continue to make the same mortgage payment that he has been making for the 3 years of owning the home. He's going to pay the same amount for that new 23-year mortgage. But the difference, and this is the big piece, the difference is by paying that extra piece, Joe's going to save over 100, and depends on, again, how exact you are, if it's exactly here or not, but over 100,000 easy, over 100,000 in over the lifetime of loan and interest paid. And again, he builds equity quicker. Maybe the mortgage insurance goes away, but Joe gets it to where he's now saving, instead of that, $3,600 cash flow, which, by the way, when he got that, he's technically, his loan became more expensive. Even though he gets to keep that cash flow doing the 30-year, he actually is going to pay more interest, because now instead of paying the original loan off, in 30 years, it's 33 years. And in addition to that, he's resetting the clock to where in the beginning, he's added 3 more years of paying a whole bunch of interest. So with all that said, again, it's really important just to understand, what is the objective? When you do this, is it monthly savings versus monthly cash flow? If somebody really needs that cash flow, because maybe that few extra $100 provides some relief somewhere, gives them, whether they can pay off other debt that's more expensive, or whether they can just add it to savings, or whatever they need it for, there's absolutely valid reasons to do that. But I just need folks to understand there is a difference between a 30-year versus a 23-year mortgage. And when you break down the differences, ultimately it comes down to what's really important. We got to weigh your options. Is it monthly cash flow, or is it monthly savings? So again, monthly savings, you're going to reduce the cost of the interest. You're going to reduce the term. You're going to pay it off quicker. It's just all those good things happen. But the monthly cash flow, it does free up cash. It can use it to lower your other monthly expenses. You can do whatever you need to do. But again, really important to at least know this exists. Again, it's not for everybody. Not every lender can do it. But the reality is, it is super important that you, as a homeowner, know what your options look like. And if you're not sure, reach out to the Mortgage Mark team. We are here to help. Yes, it's a shameless plug. I can go to mortgagemark.com, and we'll be happy to walk through it and tell you exactly what it is, and also tell you if the refinance even makes sense. Because the wrong way to do it is to say, oh, I'm saving this many dollars every month, divide that by your cost. That's not right. Again, that's not savings. That is cash flow. Most of the industry will do cash flow, right? They'll take okay, if it costs you, making up some numbers here, if it costs you $3,000 to close and you save $300 a month in your payment, that's 10 months break even. It's not accurate, because again, you're resetting that clock, which adds more interest. So figure out the actual savings, because a 23-year mortgage is absolutely less expensive, but there's no, quote, monthly savings because the payment's comparable. But yet the break even, the reason why you should refinance lies in the number of the savings. So monthly cash flow versus monthly savings, very different. So if you do need us, reach out to us. And remember, as always, when you think mortgage, think Mark.